Why do investors instantly reject pitch decks? 4 red flags. Imagine presenting your startup idea to an investor and seeing their face change in seconds. What causes that quick rejection? Often, it's red flags hidden in the pitch deck. When investors review these presentations, they look for signs that the startup might be too risky or unprepared. If they spot issues early, they tend to reject the pitch immediately. One common red flag is a weak or poorly defined business plan. Investors want to see a clear mission, strategy, and target market. If the plan is vague or unrealistic, it suggests the startup lacks direction or understanding of its market. For example, claiming to target everyone with no specific niche makes the business seem unfocused. Financial planning is another big concern. Investors expect detailed revenue forecasts, cash flow estimates, and a clear path to profit. If the numbers seem overly optimistic or unsupported by data, it raises doubts about the startup's management. For instance, projecting millions in revenue within 6 months without evidence can be a red flag. Market validation also matters. If the pitch deck doesn't show proof that customers want the product, like user data, testimonials, or pilot results, investors see it as a risky venture. Without evidence of demand, they worry the business might not succeed. Differentiation is key. If the startup cannot clearly explain what makes it unique or better than competitors, investors get confused. They want to know why this startup will succeed where others have failed. A lack of a strong competitive advantage can be a deal breaker. Presentation quality also plays a role. Investors review many decks and only spend a few minutes on each. If the slides are cluttered, confusing, or filled with jargon, they lose interest fast. The message needs to be simple, engaging, and easy to understand. The team behind the startup is another red flag. Investors look for experienced, stable teams. High employee turnover or founders with no relevant background can make investors wary. If a startup has been raising funds for years without success, it raises questions about its potential. Finally, an unclear or missing exit strategy can cause rejection. Investors want to see how they might make a profit, whether through an acquisition, initial public offering, or merger. Without a plan for future growth, the investment seems uncertain. For startups, these red flags highlight the importance of thorough preparation. The pitch deck should be a straightforward story covering the business plan, financials, market demand, competitive edge, and team credentials. It should be visually simple and use accessible language. Start by developing a detailed, realistic business plan before creating the deck. Support financial projections with data and clear assumptions. Show evidence of market validation. Clearly state what makes your startup different and why it matters. Keep the language simple and visuals clean. Highlight your team's experience and stability. And include a clear plan for how investors can expect to see a return. Addressing these areas can help you avoid instant rejection and increase your chances of catching an investor's interest. Remember, a well-prepared pitch deck is your first step toward turning an investor's no into a yes.